Looks like everyone can hear us. And so in the interest of time, we're going to go ahead and get started. Even as people come on, please continue to join us. I am Arleen Garza. I am one of the principals of REEP Equity and REEP Residential. My husband Jacob and I started this company in 2012 when we bought our first 24-unit property and managed it ourselves. Fast forward to today, we purchased 34 assets, about 750 million in assets under management throughout that time. And we've learned a lot along the way. And the other nice thing we did was we started our own management company. A lot of that, all of that was because we wanted to control what happens at our properties, such as who we hire, making sure that they follow the same mission that Jacob and I have of taking care of the property and the residents. And, all the wonderful things that our team does on the properties to keep them looking great. So with that, over the last 5 years, Tim Ellis joined us, and Tim is our Vice President of Acquisitions. And he's been responsible, along with his team, Victoria, and our analyst team, in helping us buy all of the assets that we bought over the last 5 years. So, Tim, tell us a little bit about you.
Awesome. Thanks, Arleen. Yes, I've joined REEP over 5 years ago, and my background has always been commercial real estate investing, multifamily for 8 years now, or close to 8 years. I'm a very interested person when it comes to interest rates, the 10-year treasury. This is my favorite topic, so I hope y'all have like 6 or 7 hours and we can just skim the surface of it. But
yeah, he's kidding, obviously.
But yeah, I've been responsible with my team, with Victoria as well, and our team. And not only the acquisition side, but the asset management side. I'm the Vice President of Acquisitions, Asset Management, and Development. So, my teams are working on the acquisition side, the disposition side, the capital market side, whether that's refinances or, acquisitions, dispositions, asset management side, we're working on the properties with our management company. And then on the development side, seeking new ground up opportunities.
Fantastic, Tim. So without further ado, let's get into our topic today, interest rate cuts and what it means for multifamily investors. Thank you all again for joining us today. We are excited to have you on. We will share some thoughts, and then afterwards, we'd love for you to put your questions into the chat box, and Tim and I are happy to answer them. So let's talk about starting out with, what do Fed rate cuts mean? Actually, what do they do? I don't know if we have the... Okay, awesome. There we go. Thank you, Vanessa. So the Fed funds rate. Well, first of all, I want to share, I was in banking for 20 years. And so Fed funds rates mean a lot to bankers and a lot to the lending community in general. So really, the Fed funds rate determines the interest that is charged in overnight cash reserve transactions between banks. So what does that mean? So as a bank, for example, Bank of America can borrow overnight utilizing the Fed funds to settle transactions back and forth. And so that's where the Fed funds rate comes in. They're also known as the central banks. And so their rate decisions really affect borrowing cost across the board, as lenders typically set rates based upon the Fed determined range, these Fed funds rates that you hear a lot about. So what will rate cuts, we've already had our first one, what will they do? Well, they'll ripple through the economy broadly, and here's some examples. Mortgage rates hit a 19-month low last week of 6.2% on 30-year fixed loans. They'd been much higher than that. I think 8.7% was a rate that I saw a few months back. And so this downward descent will continue as the Fed further cuts rates. Also, consumer loans get cheaper with lower Fed funds rates. And what does that mean? Banks are big auto loan lenders. And so things like auto loans will get cheaper. Other variable rate debt, such as credit card interest rate, should also come down. Companies will also reap the benefits of more accessible credit. So, when rates are high, companies don't borrow because the payment, the debt payments get so high that they don't fit into their budgets. And so companies don't grow, right? They don't borrow for equipment. They don't borrow for other things. And in the case of real estate, interest rates really are a big factor in how much transaction volume there is among sellers and buyers. So rate cuts are typically considered a boon for the stock market. What does that mean? Because I know a lot of investors have money in the stock market. Well, as money gets pulled away from lower yielding government bonds and money market funds, then investors look at alternative investments like real estate, seeking higher returns. So that is a good thing for those of us in real estate because it means more investors come back into the market. But Tim, I'd like your take on what other things are affected. We've talked about the loan side. What else is affected by these rate cuts?
Yeah, I mean, so as Arleen said, the Fed fund rates directly impact the interest that banks and credit unions are willing to pay for money put in savings accounts, money markets, certificate of deposits, or CDs, right? So when rates go down, like they're going down now, so does the interest earned on these dollars. So the market and the people who have been putting dollars in these savings accounts and these higher yielding savings accounts are going to start seeing a reduction in the interest that they're earning for those dollars. And my belief is that when that happens, as the rates come down and as people are earning less and less interest for the dollars in these accounts, this will lure people off the sidelines, so to speak, sidelines, and invest into more higher yielding assets such as multifamily investments. So basically, as rates are cut, they're going to earn less on their savings accounts and CDs. So interestingly enough, as rates go down, in that sense, so do the rates that impact our borrowing costs for when we buy multifamily assets. So when that happens, we are able to finance these assets with better loans, which make the returns, allow the returns to go up. And therefore, the difference between what a CD would offer and what a multifamily investment opportunity might offer widen, and all of a sudden, multifamily looks a lot more attractive in a downward Fed fund rate environment because you're not getting paid as much anymore to just park your money in a CD.
Right.
So, yeah.
Well, let's look at, what does the borrowing look like for things like multifamily?
Sure. And there's another rate cut coming in November.
Mm-hmm.
And right now the CME watch, right? The people who are watching the dot plots are right now cooking a 60% chance for another 50 basis point cut in November.
Wow.
So I don't know if everyone was watching it as closely as we do or I do. Like I said, I'm a big nerd about this, but right before last rate cut, it was what delivered a 50 basis point cut. It was about a 50-50 chance, and it was a coin toss whether they were going to do a 50 basis point cut or a 25 basis point cut. Well, we all know what happened. They did a 50 basis point cut, and that again, you shocked 50% of people, and 50% of people are pleased with that.
Right.
And so right now it's 60-40, and we'll see as we get closer to that. November 7th is when they will release that next cut. We'll see what it does, but right now it's a 60-40. Those are some pretty
for another 50 basis
for another
rate
50
cut.
basis points.
So we play an interesting game here among the acquisitions team where we all put in our thoughts as to what we think rate cuts will be. And you're right, Tim, on the last one, it was 50-50 among our team.
That's right.
50% thought it'd be a 25 basis rate cut and 50% thought it would be 50 basis rate cut. So these numbers do matter, and those percentages change as we get closer to the next Fed meeting in November. So Tim, tell us about, and we're looking here at what the 10-year Treasury has done. Tell us why that's important to us in the multifamily world.
All right, yeah. So this is the 10-year treasury chart, right? This is just for this year, 2024. On the left, it goes from January 1, and then all the way to the right, that's today, right? So the 10-year treasury note is what you could expect to be paid on a bond, right? Or on a note over 10 years. So this is right now today saying 375. Now you'll see that this is a pretty dramatic chart. It started off the year just under 4%. In the early summer, it came up to 475. It was almost 5%. And then you see it slowly and then pretty dramatically recently started to fall down. Well, the lowest it's been all year. So why is this important? Our loans that we do and have been doing lately, Fannie Mae and Freddie Mac loans and HUD loans are priced directly related to these 10-year treasuries. Now you can price them to 7-year, 10-year, 5-year, right? And they all have different rates. But this is a very important metric that we watch all the time, and not just us, but every commercial real estate investor, every multifamily investor, um, you know, a lot of people watch this trend. The lower it goes, the lower the chance that you're going to be able to lock in a better interest rate. If a good rule of thumb, let's just say, the 10 years at 4%, a multifamily loan might be 100 or 1.5% on top of that. So 4 plus 1.5, your all-in rate is looking like 5.5.
Right.
If it's 5, that's 6.5. If it's 3, that's 4.5, right? If it's 3.5, it's 5, right? So the lower that this 10-year goes and the longer it stays lower, like it is right now, since like August, right? That is another event that lures people off the sidelines, lures investors off the sidelines, operators, buyers, REITs, whatever kind of capital out there that wants to get into commercial real estate. It takes them off the sidelines and says, all right, check it out. Our borrowing costs are 1% lower than they were at the high point of this year.
And that's significant where you're looking at a 15 or $20 million loan. That 1% makes a huge difference. And one of the other things that I think is important with these rate cuts is, John Chang with Marcus and Millichap recently talked about, that the rate cut will reduce the risk of some commercial real estate distress. It will help those that are looking at refinancing properties that have debt coming due. So that's another benefit that we see in the future. It'll help us. We'll be looking at some refinances, and so that will be a benefit for us going forward. And this reduced cost of capital, as you said, means more people jumping into the market as buyers, creating more competition, creating maybe better pricing. So let's look at, the next thing is we want to share was what the impact of interest rates have on cap rates, right? So cap rates is a big measure for us when we're looking at the price that we're going to pay for a property. So as interest rates increase, the cost of capital, as you just talked about, Tim, the borrowing cost, fluctuations in that interest rate environment can contribute to these rising cap rates. So typically interest rates and cap rates kind of move in the same direction. Now they're not 1-to-1, so you're not going to see, a 1% increased interest rates, meaning a 1% increase in cap rates, but they do move together. Just the rate of their movement is a little different for each one of them. So in the current environment, the interest rate hikes that the Fed had put into place increased financing cost, limiting transaction volume in the real estate market, making more difficult to actually assess cap rates. What should cap rates be? The Fed, this is the first rate cut that we've had since March of 2020. All of you know that have been watching this, that the Fed raised interest rates 9 times in that period of time, since March 2020 till September of this year when they had the first rate reduction. So that was a pretty pretty dramatic rise in rates that really affected a lot of multifamily properties. It affected the ability to assess what cap rate should be. And cap rates increased nationally. Multifamily, industrial, and office cap rates increased by 0.8% on average or more. And that's between the second quarter of 2022 and the third quarter of 2023. That's per CoStar. So it's been shown based on the numbers that we've seen nationally. And the Fed's interest rates cuts in 2024, as we talked about, will lower borrowing costs and decrease cap rates. So when cap rates come down, that means the value of properties go up. So if you're looking at selling something or even refinancing something in the future, a lower cap rate's going to help. And we'll show you an example of that impact here in the future, or not in the future, in a few slides from now. So the other, go ahead, Tim.
Yeah, on your point about as a result, cap rates have increased nationally for multifamily, industrial, and office. John Burns Research and Consulting, this is a fresh report that was just published today, and they polled a lot of institutional investors. They polled a lot of REITs, private equity operators such as ourselves, and they asked a lot of questions. But one of them was, when will commercial real estate asset values hit their lowest point, right? And
Interesting.
And this was asked. Why? Because interest rates have been high. They were raised dramatically pretty high, and now we're on the downward of this rate cycle. And over 50% said we're either now at a point where the values are lowest, or we will be getting to that point. So you have a really interesting time when the market is saying, okay, hey, now these values are going to be the lowest. So if the market is perceiving, right, it's all the perception of this is the lowest valuation in the market. At the same time, you have falling rates, and you have, again, the people not earning as much in their savings and putting them in their bank accounts. My opinion is that based on the perception of the value in the market of what these assets are valued at, and the rates coming down, and people not getting paid for their money in CDs, and the rates coming down, and financing costs going down, I think we're going to see a lot of interest suddenly in multifamily. People are going to be trying to time the market, which is really difficult to do.
Yeah, and we're here. They're saying we're at the possibly the lowest point or close to the lowest point.
Right.
And I think that's interesting because, BlackRock and KKR, two huge multifamily buyers, recently bought billion-dollar portfolios. So
Right.
when those companies that have extensive number of analysts and are watching the market come in that heavy, they're also signaling, we think we're at that point in the market where pricing is the lowest or close to the lowest.
Right. Yep. And I just want to read this little tidbit from the study. They're saying as inflation eases and capital becomes more accessible through reduction in interest rates, commercial real estate investors are optimistic that these assets are going to be a lot more valuable, especially in multifamily.
Great. And when that 300 billion that's sitting on the sidelines today comes back in the market, and they're starting to, as we see through BlackRock and KKR, that means more interest, means more competition, means higher pricing for assets. So we're buying now because we want that low pricing, but as we go to sell, we want the higher pricing. So
right. And to your point about the public REITs and these REITs that are traded, right? Again, that's another avenue where dollars may come off the sidelines from the CDs and the savings accounts, and they're going to go and say, you know what? I'll go ahead and allocate even more of my pension, or like a teacher retirement fund or something, right? These big institutional companies or school districts or whatever have these funds, and they might go, hey, you know what? This might be a good time to allocate more of our investment dollars into commercial real estate, particularly multifamily. So that's how it works. These big conglomeration of wealth managers, they decide year over year to say, how much are we going to allocate to multifamily or commercial real estate. And when again, when the market perceives that this is the right time or there will be a better time, those allocations go up. And then there's more demand from all sorts of investors to go, okay, we need to go and place these dollars. We need to go and put these dollars to work because, we have more allocated dollars in this
Yeah.
market. So that's another impact of these lowering rates.
I think it's phenomenal, and that's why we are so interested in what's happening with interest rates. But, one of the other things, Tim, we discuss all the time are cap rates. So we just talked about, well, what happens when interest rates go up? What happens with cap rates? Let's talk about cap rates, because I think many people have different definitions of what cap rates really are. So let's talk a little bit about that. So cap rates measure an investor's return expectations, right? So if a cap rate is call it a 6.5, that might mean, okay, there's a little more risk, so I'm going to ask for a little more reward, right? So when it comes down and that cap rate is, maybe the cap rate's a 5, okay, that's a less riskier, not as much return, but as the 6 cap rate is. So let's talk about what these are. I mean, they're forward-looking, a point in time measurement. So it's predicting what's going to happen into the future, but it's done today, right? Point in time. And they're just one unit of comparison that we use and everybody in commercial real estate uses for evaluating a property. We do need to look, though, at, and we do, the macroeconomic and property-specific characteristics that we look at when determining that appropriate cap rate. So what are these factors? Supply demand trends. We've all heard and seen the news articles that talk about markets where there's been a lot of delivery of new units into a market. So we look at how many units are being delivered into a particular market. What's the absorption, or how many of those are being rented as they're being delivered, to look at what is the demand for those units. And I'll just say, across the board, regardless of those hundreds of thousands of units that have been delivered, we are still 4.6 million units, 4.3, 4.6, depends what story you're looking at, undersupplied. So meaning there is that much more demand and there's a need for more rental units, which is great. More demand versus supply, you can raise rents and increase the value of your property. The other thing we need to look at is real estate zoning and regulations. How does that affect, the value of the property, the amount of money you're going to have to spend on that property, either to get it built or regulations to keep it operating. Credit worthiness of residents. Why is that important? We always look at the leases of every property we buy. We look at, what do those residents make? What is their credit worthiness? We actually run that data as we're screening them. And we want to make sure that residents make at least 3 times the rent in terms of income. That way we know they're not going to get into trouble with paying their rent. We look at specific lease terms and the leases coming due when we're buying a property. And that's important because we want to see, are these leases 12-month leases, 9-month leases? We really typically don't want to see anything longer than a 12-month lease. And there's a reason for that, because we can raise the rent or adjust the rents to market when those leases come due. So it tells us when we're going to be able to see an increase in our rental income. We also look at the market and the submarket health, right? Is that market on an upward trend? For example, Houston has been the #1 job and population growth market in the country. So we have, you get some cushion, right? You get some insulation knowing that there will continue to be new renters coming into that market. So pretty healthy market. But not only just Houston, we look at things like we're buying currently in Kingwood and Atascocita, which are suburbs of Houston. So we look at the health of that submarket. What are the household incomes in that market? How many households rent in that particular area? What do the jobs look like? In one particular case, there are 1.2 million jobs in that immediate submarket. So we are looking at all of that, and so are other folks as they're really looking at what cap rate should be allocated to that particular market. Looking at rent growth, we're looking at the stage of the economic cycle, right? We're saying we're kind of close to the bottom of the cycle. That means things can only go up from here. So these are some of the things that we're looking at as, we're calculating what cap rates to use on an exit versus our cap rate we're buying at. So pretty important things there. Tim, any thoughts on that, or you want to
Right.
keep going?
Yeah, no, yeah, as a you know, reminder is as Arleen said before, is that interest rates have a relationship to cap rates, right? And it's not one for one, but it is kind of a big factor when you're looking at or when the market is looking at real estate, right? The lower the interest in general, here we go, the lower the interest rates that are prevailing in the marketplace, the lower that cap rates tend to go. And you can just look at the history of, and there's lots of charts that show the where are interest rates and where are cap rates, right? And how close do they go, right? How if there are times when people where groups are buying 5% finance deals on 5% cap rates, right? That, I mean, those numbers can correlate. Now, sometimes it could be 6% interest rate at a 5% cap rate, or it could be the inverse of that. But they do move together. But you have to take a lot of these other factors into consideration when you're looking at what cap rates do and what they mean. But in general, as we've seen in history, cap rates start to compress with lower interest rates and with a lot more buying demand. Because when there's a lot more competition within the market to buy a finite amount of, tangible real estate, there's going to be competition because, like I said, there's going to be folks that need to place these dollars and put them to use in multifamily.
That's a good point, Tim, about more people coming into the market. 2021, what we are now calling the height of the market, right? When we went to purchase an asset, we were competing with, call it 25 to 30 other buyers. Over the last year and a half, we might be competing with 3 to 5 buyers. So that reinforces Tim's point of we'll start to see more buyers coming into the market, will create competition, and that is good if you're wanting to see prices go up. Not if you're buying, you want to buy the lowest price, but if you're selling, you want to sell at a higher price. So let's look at an example that will show you how cap rates really impact the value of a property. So as Tim has said, and I've said, cap rate compression, meaning a lowering of the cap rates, has historically occurred with interest rate cuts. That's not just us saying it. You can go look it up. It is historically been the case. So what does this mean? So we're going to use the example of the 2 properties that we're currently buying. Oaks of Kingwood, which is a suburb of Houston, and then Sunrise at Atascocita, also in a suburb of Houston. So we're really the formula is to determine value. You take the net operating income for that property and you divide it by the cap rate, and that tells you the value. So when we buy, we look at what is our going in cap rate? What is the cap rate based on what we're paying for the property versus the net operating income that property is currently generating? And then we pro forma out, if we're doing a 3 to 5 year hold, we say, how can we grow this net operating income using very conservative rent growth, true expense numbers, et cetera. So what we're showing you here is the example of what we've estimated for Oaks of Kingwood. So we're looking at net operating income. Of course, that's the net income minus expenses to get to the net operating income. In year 5, we're saying it's going to be $1,465,555, right? So we're saying today in our underwriting that we anticipate that exit cap rate when we sell being 5.5. So that would equate to a 26,482,818 value. So what happens if the cap rate when we go to sell declines from 5.5 by quarter of percent to 5.25. Well, what that means is that the value now increased from the 26 million we originally pro forma'd to 27,743,904. So the value, the potential difference in the sales price we could get, just looking at the cap rate, is over $1 million, $1,261,000. And that's real appreciation for investors, right? So if we're buying this asset at 15 million, selling it at 27 million, that's a very nice return, and all based on very conservative rent growth and expense numbers. So what happens if that cap rate declines even more from 5.5 to 5%? All of a sudden, the value went from that 27 million you see in the middle column to 29,311,100. So just on the cap rate again, it went up almost $3 million to 2.8 million. So that is how a cap rate truly impacts, or the compression of a cap rate can impact the value of that property. So again, we're buying it at 15 million and selling it at 29 million. That's a heck of a good return at the end. So let's look at a second example, a Sunrise at Atascocita. Again, looking at the net operating income we have from our pro forma analysis, we're saying that that net operating income will hit $1,312,465 in year 5. Again, looking at a 5-year hold. The exit cap we're using is the same, 5.5, because they're in the same market, in the same sub-market. And so we're projecting that that value would be 23,863,000. Well, if that cap rate dropped from 5.5 to the middle column at 5.25, the value of that property just went up to 24,999,333. So an increase, a potential difference in the sales price of over $1 million just through that cap rate compression. Now, looking at that last column, same net operating income, but the cap rate now is a 5%. What does that do to the value? Well, the value increased to 26,249,300. So a potential difference in the sales price of 2,386,300 just by that cap rate coming down. So this was a way for us to show you, well, how do these cap rates really affect the value of the property? And because interest rates and cap rates tend to move together, so if interest rates are coming down, so will cap rates, then we're looking at an outlook that looks pretty good for the future. So that's really what we had. I don't know, Tim, if you have any other comments on that, or we want to move and see what questions people might have for us.
Let's do some questions. That'd be great.
Okay, sounds awesome. So once again, if you have a question, please put it into the chat box. And we are more than happy to go over any and all questions you might have. And if we don't know the answer, we'll get back to you with that. All right, not seeing any yet. Hopefully some of you guys had some questions for us.
We're pulling up the question box.
Okay.
Oh, okay.
Yeah, we're not seeing no open questions right now. So really, let's just do then a summary while we're waiting to see if any questions come in. We really talked about the impact of the interest rates that the cut that the Fed just put into place. How does that relate to, oh, here we go. Here's a question. Where do you expect cap rates to go? Well,
yeah.
Tim, you tell us again what the data is showing us.
Yeah, we're expecting cap rates to compress. In general, when you have lower cost of borrowing and you have more demand and you have more capital on the sidelines coming into the market, it's gonna push cap rates down. Now, when do you think they will bottom? At what rate? So I'm thinking you're asking, when do you think they're going to be the lowest, when our values are going to maximize? Or are you thinking when our values going to be at the high bottom?
I'm reading that, Tim, as do we think interest rates will bottom?
Oh.
And what does that rate look like?
a couple forecasts have it at, by the end of 2026, we're going to expect, the Fed fund rates to get to a pretty neutral territory. And okay, when will cap rates bottom? Okay, so yeah, I think I think it depends on how quickly these rates come down. It's really gonna, I think, in my opinion, gonna mirror how fast the Fed rates come down. So if they come down pretty quickly, there's projections out there that by the end of this year, the Fed fund rate will be about 4.375. By the end of next year, it'll be 3.375. And then by the end of 2026, it'll be 2.875. I'm gonna guess the cap rates are gonna get pretty compressed by, the second half of next year and the beginning half of 2026. So I'll say pretty much the second half of 25 and the first half of 26. And at what rate? Well, good question.
If we had a crystal ball, we would definitely do that.
Yeah, it's a great question. If the treasury, let's just say, and it depends on your asset class, but it just depends on what market are you in. Primary markets, are you buying an A, B, or C? If you're, I agree. So the question or the comment is cap rates in the threes would be outstanding. Absolutely. On
We
the sale
would be
perspective.
ecstatic, and there would be a lot of properties that we would sell at that period of time.
Right. So again, if the borrowing cost ends up being, 4 to 4.5 on average, if that's like the cost of capital that buyers can generally get. I mean, like I said, we've seen the market pay a 4 or 4.5 cap on top of that cap rate. So basically, what does that mean? You know, Depending on the asset, if you're fixing it at 4.5 interest rate, you might be able to, you might be willing to pay a 4.5 cap rate.
Right.
So, or lower cap rate. Now people all the time will buy a lower cap rate because they expect value to grow in like that next year when they own the property and operate it. They can expect the NOI to go up, 10%, and then they can put their purchase on and correlate the cap rate to that and then be above their financing. So, how does this affect properties that have floating rate loans? Good question. So that's I think there was a lot of size of relief across the entire commercial real estate industry, and probably not even just, I mean, anyone who has any kind of variable rate financing. Um, um, are relieved because it starts to impact the rates now. When they lower the Fed funds rate, a lot of these floating rate variable loans are priced off of the federal funds rate. So
Or
SOFR,
SOFR, yeah.
yeah, known as SOFR, or 30-day SOFR or term SOFR. So you'll start to see in the coming months the interest rate payments go lower on any of these variable rate loans that are priced on SOFR or Wall Street Journal Prime, right? If they're
Right.
priced on that metric, it kind of just goes immediate, right? Because Wall Street Journal Prime is 350, I think, 350 bips priced on top of SOFR.
I think the other thing too is, for floating rate loans, a lot of borrowers also buy an interest rate cap, which is insurance that basically caps your interest rate that you're going to end up paying. And what we've already seen is that the price of those interest rate caps has come down pretty dramatically. So that's also going to help individuals that have floating rate loans, because if they're required on an extension or modification of a loan to buy a new rate cap, those rate caps should also come in at a better price. So that's awesome.
So-
How will inflation tie into this? If
Well-
it picks up again, do you think rates will rise?
Right. Yeah, so I mean, that's a good question. I think that's a lot of the fear of like, hey, are you cutting rates too soon? Inflation's going to rear its head. But I think there's a lot of data out there on like these past cycles where inflation has reared its head and they pushed it down. You know, they raise rates to combat it, and then they lower rates to offset the slowing of inflation. And I think what the Fed's trying to do in a nutshell is say, hey, look, we're already consistently working on a trend. The trailing numbers are showing that our inflation is improving, and if they keep rates for too long, they're going to um,
Hurt the economy.
hurt the economy
Even
really,
more.
yeah,
Yeah.
pretty bad. So you know, well, you know, I think they if inflation picks up again, which, you know, they're cutting because they don't think it will. But if it does, do you expect rents to increase as well? Well, and second part of that question is generally how much do rents correlate with inflation? Now, I don't think that there's like a hard like one for one. It's all location driven. It's all market driven. It's all asset driven. It is all, you know, focused on the immediate area. So, what do I mean by that? If you know, if there's 10,000 units in a submarket and all 10,000 units are leased or pre-leased, and there's a ton of demand to move into a certain area, a certain geographic area of a city, you can be in high inflation, low inflation, no inflation, and there's still going to be some upward movement on those rents in that area because of the lack of supply. So I think like the micro submarkets and that analysis as well. We're very keen on doing all the
Right.
time, um, uh, to make sure that the properties are well positioned in our hold period to benefit from organic rent growth, no matter what kind of environment we see ourselves in.
Well, and I think the thing that is commonly known about multifamily investing is that it tends to be inflation resistant. And the reason is, you know, our leases come due every 12 months. And so we are able to stay on top of market rents every time we change a lease. And every day there's leases renewing, right? So they're renewing at the current rates. So as inflation goes up, as the cost of bread and milk and everything goes up, typically so do rents, unless you've got a market where you've got a flood of new construction units being delivered. So typically it is a great inflation resistant investment. Do we forecast trying to sell some of our properties? You know, we are always looking at the values of our properties. We're always looking for the right time and the right opportunity to sell those properties. It is a property by property basis. So, you know, we will continue to look at those, and if it makes sense, if we're hitting our projections, then we will look at going to market. But as Tim said, as rates come down, there will be more buyers. And so when you have more buyers and more competition, you know, those are the conditions you want for going to the market to sell properties.
It says, I guess it depends on the 10-year treasury rate and what the lender is offering as a safe rate. So maybe that's in reference to cap rates. And yeah, there's definitely you know, a correlation to what the 10-year treasury is and what, you know, the market will uh accept as a cap rate. But again, that's not exactly one for one, and there's a lot of other.
And there's, you know, are you buying with negative leverage? Are you buying neutral leverage? What are you buying based on what interest rate you're paying? So there's a lot of factors that go into it. We look at every single one of them. I'll just say that. And we will always err on the conservative side, because if your numbers are conservative, then we sleep at night, right? We know that what we put forward makes sense on what's happening in the market. So it looks like we have come to the end of the questions, and we're sitting at about 12:45. So we thank you again for joining us today. Thank you, Tim,
Yeah,
for all
thank
your
you.
great knowledge that you've shared. That's our team goes through this information on a daily basis. We're watching rates, we're watching all of these cap rates, we're watching all these factors to ensure that we're buying properties at you know, a good value, and that there's opportunity to increase that value. So when we sell in the future, we're selling at more than what we paid for it, hopefully much more than what we paid for it. So thank you again for joining us today on another REEP Huddle. Look out for an announcement next month. If you're interested in looking at our latest investment opportunities, please or to be part of our investor database, please reach out to us at invest@reepequity.com, and that's REEP equity.com. And again, thank you for joining us, and we look forward to talking to you again soon.
Thank you so much.